cut the noise. Welcome to today's Data-Driven Explainer. I'm your chief macroeconomist, and today is August 10th, 2026. We're not here to chase retail sentiment or cheer on index all-time highs. We are here to look at the cold, hard structural dynamics pricing global assets right now. Tier 1 institutional research is flashing red, warning us of severe cracks in our macroeconomic foundation. Today, we're dissecting the anatomy of this freakish market rally and mapping out exactly how you, as a capital allocator, need to adjust your portfolio right this second to survive this unprecedented macro contradiction. Let's get to work. Here is the rigid 5-part institutional framework we're tearing down today. First, we'll look at the macro foundation. Second, Treasury dynamics. Third, equity and flow. Fourth, institutional scenarios. And finally, the final verdict.
Starting right off with Section 1, the macro foundation. Right now, our macro data is in a state of absolute structural contradiction. Look at these numbers. July non-farm payrolls dropped by 23,000. That is a glaring recession signal, right? But then, look at headline CPI, stuck at 3.5%. That completely overshoots the Fed's target, locking in structural inflation. And to top it off, Brent crude just blew past $87 a barrel. So we've got a contracting labor market slamming right into commodity-driven inflation. This is the textbook trajectory of 1970s stagflation. It's absolute poison for your standard 60-40 risk parity portfolio. The data is practically screaming that the system is overloading.
So here is the million-dollar structural question. Inflation is sticky, oil is surging, and jobs are shrinking. The rising cost of capital should be suffocating risk assets right now. So why on earth are equities stubbornly hanging out near all-time highs? Is this a genuine victory for fundamentals, or just an optical illusion created by mechanical flows?
The answer lies entirely in the market's microstructure and psychological distortion. First step, extreme short covering. Institutions that bet heavily on a labor slowdown are getting their short positions forcibly liquidated, and that's artificially pumping up prices. Second, we're seeing purely speculative front-running on rate cuts. Despite that sticky inflation, money markets are pricing in a 44% probability of a September cut, basically betting on a dovish pivot that hasn't even happened. And finally, the market has been completely hijacked by this bad news is good news narrative. A 23,000 drop in jobs is being celebrated as a guaranteed ticket to a Fed surrender, entirely papering over the massive structural inflation nightmare staring us right in the face.
Moving on to Section 2, Treasury dynamics. We are seeing severe, unprecedented cracks in the Fed's policy consensus. The official FOMC line was supposed to be a hold, keeping rates in that 3.50 to 3.75% pocket. But for the first time since 2016, we've got 3 Fed presidents, Hammack, Kashkari, and Logan, all throwing down hawkish dissenting votes, demanding a 25 basis point hike. Do not ignore this signal. 3 members breaking ranks to hike means the Fed's internal data models are flashing code red on entrenched inflation. That unified front is totally shattered, and the tail risk of a hawkish surprise just spiked massively.
And the bond market, it is reacting violently to this fracture. The 30-year long bond yield just ripped past 5.25%. We haven't seen that number since 2007, right before the global financial crisis. Make no mistake, a 5.25% long yield isn't a sign of robust economic growth. It's the manifestation of pure, unadulterated fear regarding structural inflation and duration risk. Smart money does not believe the inflation genie is back in the bottle, and they are demanding a massive premium to lock up their capital for 3 decades.
What's really turning asset allocation models upside down right now is real yields. The 10-year TIPS, the real yield, just touched 2.42%. The spread between that guaranteed real yield and the S&P 500's dividend yield is now the widest it's been since the dot-com bubble burst in the early 2000s. Think about it analytically. If an institution can lock in a risk-free return that beats inflation by nearly 2.5%, the equity risk premium simply collapses. Treasuries had become an incredibly magnetic black hole for equity capital right now. Let's unpack Section 3, Equity and Flow. Now let's look at the fundamental mirage blinding retail investors. On the surface, the S&P 500's Q2 earnings look flawless. Wall Street modeled 23.6% earnings growth, but we actually got an astronomical 51%. Companies are relentlessly passing costs onto consumers to fiercely defend their margins. And it's this historic earnings surprise that's providing the air cover to justify these inflated index levels. But as institutional analysts, we need to dig into where this growth is actually coming from. Because the source of that growth is terrifyingly concentrated. In Q1 of 2026 alone, big tech poured a staggering $130 billion into AI infrastructure capex. This is not broad-based economic expansion. This is a historic, hyper-niche capital funneling. The broader market is actually cooling off, but the massive gravitational pull of that $130 billion is forcibly dragging the entire market cap-weighted index up with it. This isn't healthy bull rally. It is extreme concentration risk that could violently snap at any moment.
You see this concentration playing out is fierce alpha hunting right inside the megacap space. Just look at the split reality between NVIDIA and Apple. NVIDIA is acting like a global capital black hole, structuring a $500 billion AI infrastructure fund with Wall Street titans. Meanwhile, Apple just caught a downgrade from Jefferies after having to scrap their 2027 all-glass iPhone project due to yield issues. Capital is ruthlessly punishing companies with supply chain bottlenecks, while blindly chasing the AI infrastructure leaders. Market breadth is literally as narrow as a needle.
Next up, Section 4, Institutional Scenarios. While the equity market is drunk on AI euphoria, a massive tail risk is brewing in the energy sector. The pivot point is Brent crude at $87. The standoff in the Strait of Hormuz is pushing past critical thresholds, and over the weekend we saw missile strikes on UAE-linked tankers. If 20% of global energy supply gets choked off in that bottleneck, oil prices will go parabolic. That is the exact detonator that will completely shatter the disinflation narrative the Fed has been desperately relying on. We also need to analyze domestic policy shifts strictly through the lens of capital flow and sector impact. First, the DSA's push for national health care is forcefully shifting the tax crosshairs onto businesses and pass-through entities. Second, that exact tax burden is accelerating a massive corporate exodus from high-regulation hubs like New York down to free enterprise states like Florida. Third, Trump's executive order extending childhood vaccine schedules. Removing all political bias, we have to recognize that this demands an immediate repricing of future cash flow models in the healthcare and pharma sectors. Capital doesn't care about politics, it just aggressively avoids regulatory risk to find efficiency. I want to share the sharpest takeaway from this morning's institutional desk briefings. Quote, "The long end, which ignored every soft labor print this summer, is the honest scoreboard. The equity market might be running on the fumes of liquidity and AI fantasies, but that 30-year Treasury yield hitting 5.25%, that scoreboard doesn't lie. The bond market is mathematically pricing in the reality of entrenched inflation, massive debt issuance, and geopolitical supply shocks. As macro strategists, we must always respect the bond market's warning." Finally, Section 5, the final verdict. Based on the raw data we synthesized today, here are the exact tactical plays you need to execute. Scenario A, the bullish continuation. For this to work, Wednesday's CPI must print at or below 3.4%. That gives the Fed the cover they need to hold rates without a hawkish panic. Simultaneously, AI capex has to keep generating earnings that absolutely crush expectations. If, and only if, those conditions are met, you maintain an overweight position in equities, specifically hyper-concentrating your portfolio in infrastructure cap tech. But you must be aggressively prepared for Scenario B, the stagflation reversal. If oil breaks $90 and drags CPI up with it, the hawks at the Fed take the wheel. If the 10-year yield reaches major resistance thresholds, the equity risk premium is officially dead. The absolute second those thresholds break, you flip to underweight equities. You must aggressively rotate capital into defensive assets, lock in that 2.42% real yield on tips, and massively scale up your hedges in gold, which, by the way, central banks are hoarding right now as emergency rations. I'll leave you with a cold, structural question for your own portfolio. Are you currently allocating capital hoping for an AI miracle? Or are you actually hedging against a very real stagflationary reality? The equity market is pricing in the miracle. The bond and commodity markets are screaming about the reality. You cannot mathematically have both. Look at the data, make your decision, and adjust your risk immediately.